Hi, my name is Ariana Alvarado,
And my name is Fatoumata Traoré.
and we decided to do our project on McDonald's versus Chipotle. McDonald's restaurant is a international fast food chain that has over 36,000 restaurants in over 100 countries around the world, and it is one of the world's top fast food service brands. McDonald's was founded in 1954 in California by Ray Kroc, and this is their mission statement. McDonald's Corporation is part of the New York Stock Exchange market, and they are involved in the franchise and operation of McDonald's restaurants and operate through the succeeding segments. The US segment, which focuses on increasing customer awareness for McDonald's mobile app, International Leads Market, which manages the expansion of the McCafe coffee brand and the ongoing deployment of the EOTF restaurants across the segment. The high growth markets, which involves the ideas around design, digital, people menu innovation, and value from other markets to enhance customer experience. And lastly, foundational markets and corporate, which refers to commitment to run great restaurants and increase convenience to customers, including drive-through and delivery.
Chipotle Mexican Grill Inc. is an American chain of fast casual restaurants in the United States, United Kingdom, Canada, Germany, and France, specializing in tacos and Mission-style burritos. The company's Chipotle Mexican Grill restaurants serve as many of burritos, tacos, burrito bowls, which is a burrito without the tortilla and salad. Its name is derived from chipotle, which is a smoked and dried jalapeno pepper. The company was founded on July 13, 1993, and their mission statement is Food with integrity is our commitment to finding the very best ingredients raised with respect for the animals, the environment, and the farmers. Chipotle Mexican Grill Inc., incorporated on July 30th, 1998, together with its subsidiaries, operates Chipotle Mexican Grill restaurants. Chipotle operates in the fast casual industry. It faces direct competition from four other companies. Those companies include Qdoba Restaurant Corporation, MTY Food Group Inc., MSW LLC, and the Rubio's Coastal Grill. Chipotle also competes on a less head-to-head basis against Taco Bell Corporation, the market leader in the Mexican-style food sector. As of December 31st, 2016, the company managed its operations and restaurants based on 11 different regions.
In the United States, the fast food industry generated a revenue of $200 billion in 2015, which is a huge amount of growth since the 1970 revenue of $6 billion. An annual growth rate of 2.5% over the next several years is expected. This percentage is below the long-term average, but is coming back up after a slump. Over 200,000 fast food restaurants in the US exist. It is projected that about 50 million Americans eat at one every day, and fast food restaurants employ around 4 million people. Here we have a table that has the top 5 segments by market share of the fast food industry. McDonald's would be in the hamburger-focused restaurants, while Chipotle would be under the Mexican restaurants category. The cash attained via some form of financing is referred to as capital. Debt and equity are the two main ways companies finance operations. The amount of debt and equity a company requires depends on the nature of the business. For growing businesses, operations capital is an essential element. It keeps everything flowing and ensures that everything is run smoothly. However, it is also essential for already successful companies who aim to employ an acquisition growth supply. In spite of a run-in with debt, McDonald's enterprise value, or takeover price, has significantly increased. Enterprise value takes the company's debt capital into consideration, while market capitalization only regards the price and shares outstanding. Their enterprise value has gone up because they use debt to pay for billions of dollars in share repurchases and dividends paid out to investors. However, this does not mean that McDonald's is in trouble. It simply means that the price of money is very low, and McDonald's is utilizing this cheap capital to repurchase shares and pay amounts of dividends while they are sitting on a big amount of cash. From 2014 to 2018, debt significantly increased. However, since the rates of debt are still so low, the rate that is required to make the investment in shares profitable is maintained. Since McDonald's anticipates their stock is going up in the future, they view their purchasing of shares with cheap debt as a good investment.
The four largest individual shareholders of Chipotle Mexican Grill are Steve Ells, founder and former CEO of Chipotle Mexican Grill; Montgomery Moran served as the co-chief executive officer of Chipotle Mexican Grill until December 2016; John Hartung, chief financial officer since 2002; and Albert Baldocci, director at Chipotle. We learned from Chipotle's 2017 Statement of Shareholders' Equity that an amount of 38,833 shares belonged to common stock by December 31st, 2016, and 35,852 shares belonged to common stock by December 31st, 2017. We also learned that 7,019 shares belonged to the treasury stock in 2016, whereas 7,826 shares belonged to the treasury stock in 2017. Chipotle Mexican Grill does not utilize long-term debt financing to fund its operations. Utilizing cash, funds from its investment balance, and cash flows from operations, Chipotle is able to operate without any debt obligations. This slide provides us with information on Chipotle's trading history all the way up to 2018. As we can see, the majority of Chipotle's shares are held by institutions, and only 2.48% of shares are held by insiders. Even though our previous data is based on information related to 2016 and 2017, this information is still relevant because it represents the change up to 2018. So the years 2016 and 17 are therefore included. The following slides include information related to financial statements of both corporations.
The following slides will show McDonald's financial ratios. Here we have the liquidity ratios and asset management ratios for McDonald's. Liquidity ratios show the relationship of a firm's cash and other current assets to its current liabilities. So as you can see here, from 2016 to 2017, McDonald's assets became more liquid, which is good. And then as for asset management ratios, that refers to measuring how effectively the firm is managing its assets. And here you can see that in 2016, McDonald's was more efficient with their asset management. On this slide, we have the debt management ratios, profitability ratios, and market value ratios for the McDonald's Corporation. Debt management ratios are a set of ratios that measure how effectively your firm manages its debt. So here you can see they did do better in 2017. However, for their total debt to capital ratio, it is above 100%, which is unusual. It is like this because they use a lot of debt to buy and repurchase stocks, so their equity is actually at a deficit. Then we have the profitability ratios, which is a group of ratios that shows the combined effects of liquidity, asset management, and debt on operating results. Here we also see improvement from 2016 to 2017. And finally, we have the market value ratios, which are ratios that relate to the firm's stock price to earnings and book value per share. So here we also see an improvement from 2016 to 2017.
We will now take a look at Chipotle's financial ratios calculated from the information supplied on the financial statements. We can see from the information we have that Chipotle was more liquid in 2017 than it was in 2016. That means that in 2017, Chipotle had a higher ability to convert its assets into liquid. When it comes to asset management, both years were productive. We have not included total debt to capital ratio for Chipotle because we have learned from Investopedia.com that Chipotle Mexican Grill does not use long-term debt financing to fund its operations. Utilizing cash, funds from its investment balance, and cash flows from operations, Chipotle is generally able to operate without any debt obligations. The absence of long-term debt is reflected in the financial statements. However, we still calculated the time interest earned to have an idea of the company's ability to pay minimal debt, and it seems like the company improved from 2016 to 2017. It is clear that Chipotle's efficiency and created profit was higher in 2017. The firm's market value ratios were higher in 2016. As we can see, there is a big difference between the price to earnings ratio in both years, and that is due to the fact that earnings per share were very low in 2016, 0.78, compared to 2017, 6.19. We will now compare and contrast the ratios of both corporations. If we compare both companies' asset management ratios, we can see that Chipotle is actually managing its assets more effectively than McDonald's. Due to the fact that McDonald's is an older company with a lot of experience and success, we expected their numbers to be better than Chipotle's, but apparently that is not the case. Maybe the fact that Chipotle is a younger restaurant that has frequent changes in management enables them to be more innovative on how to effectively use their assets.
Next, we will discuss the debt management ratios of McDonald's and Chipotle. So for both corporations, for the total debt to capital ratio, we have a little bit of unusual results. So basically, the total debt to capital measures the percentage of the firm's capital provided by debt holders. As we discussed previously in the capital structure section, the total debt to capital for McDonald's is very high because they mostly use debt to finance their activities, repurchase shares, and pay dividends, whereas Chipotle only uses cash to finance their activities, which is why their total debt to capital ratio is not included. Also, here we have the times interest earns ratio, which is a measure of the firm's ability to meet its annual interest payments. So basically, it's the extent to which operating income can decline before a firm is unable to meet its annual interest costs. So it kind of shows the firm's safety net. As you can see, for both corporations, their times interest earn ratio did increase, which is improvement, and you can see that though they both had an increase, the times earn ratio for McDonald's is significantly lower than Chipotle, meaning that they have less of a safety net. Next, we have the profitability ratios. Here we have all of the profitability ratios for both McDonald's and Chipotle. So basically, these ratios show the combined effects of liquidity, asset management, and debt on operating results. Both had an increase from 2016 to 2017, which is very good for their business. But while looking at these ratios, it's important to look at the number of the ratios to see what each suggests, and then look at the overall situation before you judge the performance of a company and consider what actions it should undertake to improve. So though Chipotle's number percentages are quite lower than McDonald's, you need to actually go and look at the numbers before you can make any serious conclusions about the state of their corporation.
When we observe the market value ratios for both corporations, we can notice that Chipotle has higher market value ratios. This means that Chipotle shares have a higher value than McDonald's shares in the market. McDonald's notoriety and experience give them an advantage in the market, and due to its high book value, we expected them to have a higher market value. But Chipotle is very popular and continues to rise in popularity, so that could explain why. We have now analyzed both corporations and we have concluded that both of these corporations are very competitive in their industries, but they could be even more competitive if they change certain aspects of their financial plan. I have mentioned earlier that Chipotle does not use debt. Chipotle not using debt could be a good thing, but using some debt would be even better as it would give them the funds to expand their business. Debt does not have to be a burden.
McDonald's should use more capital instead of debt to improve their total debt to ratio, which is pretty much the opposite of Chipotle. Unlike them, they use a lot of debt to finance their operations daily. So, in order to improve their total debt to capital ratio, it would be essential for them to start using more cash instead of debt.